Today, let's talk about priority lending. Hello again, it's Martin North from Digital Finance Analytics. Welcome to our latest post covering finance and property news with a distinctively Australian and New Zealand flavour. And today I'm joined again by property expert Joe Wilkes. Hello, Joe.
Morning, Martin.
Now, we're going to talk about a rather interesting subject today, which some people may not be aware of. It's called priority lending. So what are we talking about?
This is something that I encountered back in the UK, 12, 13 years ago. Basically, it's where banks, when you take out a mortgage, what they do is they set they pay your solicitor to pay your seller's solicitor the funds, but they set what they call a priority amount on the mortgage that you've taken out from them. And this priority amount can often be in excess of the mortgage that you've actually taken out to borrow a property. Now, in the UK, the reason for it is that, say, for example, you're borrowing a house at £500,000. You've taken on a mortgage at £400,000. And what the banks in the boom did was that they would assume that, okay, well, you got 20% equity, prices are going up. Largely because they were lending more money into the system every year. What we'll do is we'll set a priority amount of 600,000 on your purchase of 500, and the reason they do that is that their assumption is that the price is going to carry on going up to 600,000, and that you might want to borrow a little bit more. It could be for a boat, could be for a car, could be for a nice fancy cruise, but you'll feel comfortable doing it because you've still got that buffer of equity. The two reasons for them doing it are, one, it means that if you do want and seek additional lending, that you're pretty much tied to them to do it. They've got this priority over your house as the first charge, and it I suppose it reduces the competition of you going to another lender and seeking financing from them. More cynically, it provides a buffer in the event that your circumstances change. And by this, what I mean is that you've bought the house at £500,000, you've taken your mortgage of 400, they've set their priority amount at 600,000, and okay, prices go up over a 12-month period, and we've seen in Australia and New Zealand 10% price rises per annum, and sometimes even greater than that. So your house that was 500 is now worth 550,000. You lose your job. Initially, you're able to pay off your mortgage with a buffer. You've got some savings, and you continue to service the loan. 6 months down the line, and most households, I mean, in America, they talk about 25% of households not being able to find $1,000 to cover an unexpected bill. But 6 months down the line, you're starting to get into trouble. You've not found employment that pays back or pays the same as your previous employment did. Or you've not found any employment at all, and you're starting to get a shortfall on your mortgage. Now, what the priority amount does is that if you're not paying it back, providing there's still equity in the house, and at the moment the housing market hasn't fallen, it's you who's in trouble, not the whole market, is that the priority amount allows the bank to allow you the missed debt payments to be added onto your previous loan. All of a sudden your equity can go and disappear. Now, I saw this happen in the UK, and I had a number of clients of mine who lost jobs during the banking crisis with quite heavy mortgages, and where we'd seen those houses that had been £500,000, they'd gone to 550, they'd gone to 600. Crunch hit, no jobs, no buyers either, and all of a sudden the house price was back down at 400,000 or 375,000. And the debt was building up. Now, in some circumstances, the banks would go and say, well, look, the debt's there, it's going to build up. This chap's a 40-year-old, he's still got 25, 30 years in the labour force. What we'll do is we'll let him ride it out, because at some point he's going to get the income to go and pay us back. Those people were safe. Largely it's where they didn't lose any equity. The guy who'd had a £200,000 mortgage on that purchase price of 500,000, there was plenty there for the bank to allow it to increase for a while, still had an equity buffer, but then they would take a call of, do you know what, we will force a sale on this. We would, mortgagee sales. So it was a strange situation where during and after our financial crisis, sometimes it was those that actually had greater equity in their properties who were the ones that were being forced to sell over those that the banks looked at it and said, well, there's no equity left, so we'll just keep letting it build up on our priority amount. Now, typically in the UK, priority mortgage lending, it's not enormous, and normally you're looking at possibly 10% over a mortgage balance at best. I've not seen it in my experience of beyond 10% of an outstanding mortgage balance, but I've done some research here, and we're really fortunate in New Zealand in that we're very open about data. I can go to LINZ and get information about whether a household has a mortgage, and it will tell me as well what the mortgage instrument is, who the bank is, and what the priority amount is. So I'll run through a few little stories here. This is just I've done 8. I've just looked at them at random. I did it this time last year when I was looking around the market and just trying to fathom what's going on in New Zealand. So we'll start with number 1. It was I won't give addresses because I think that's unfair, and quite a few of these houses never went on to sell, so it would be remiss of me to go and publish people's individual data. But we'll call it property number 1. They had a government valuation, so government valuations are put on properties to attribute rates and council costs to. I find it quite interesting that across the country, we mentioned it previously, but across the country you've got these government valuations which have gone up 30%, 40% in 3 years, and it's used by estate agents to go and talk about, well, you've got to pay the government valuation, when actually we'll see how realistic they are over the next few months. So property number 1, government valuation was 910,000, updated in 2017. It was bought in 2006 for 440,000. There was a mortgage taken out on it in 2010. So after the purchase of 440, there was another mortgage taken out, or a remortgage taken out in 2010, with a priority amount of 675,000. So over 30% bigger than the loan size, than the initial purchase price. Another property, property number 2, bought in 2010 for 1.12 million. Mortgage taken out in August of 2010 with a priority amount of 1.68 million. So an enormous increase on what the actual purchase price was, and I'm hoping that the purchase price wasn't a full mortgage when they bought it, but assuming they had, I don't know, 25% equity in it, you've got a priority amount that's almost double. So there's that guesstimate that we're going to see these prices carry on going up, and we will continue to make the remortgaging very, very easy if people want to just tap in and take a little bit out and take a little bit out and take a little bit. Don't have to go back to a solicitor. You just go and get in touch with the bank. The original purchase has already set the priority amount. Number 3, mortgage taken out with a priority amount of 849,000 on a government valuation of 580,000 in 2017. Number 4, which was where are we? There we go. A fairly new build, no previous sales history, government valuation of 930,000, a plot purchase of 300,000, and a priority mortgage lending figure of 1 million. Number 5, built in 2003. Plot originally acquired in 2002 for 200,000, government valuation of 1.1, and a priority amount in 2012 for 1.38 million. Number 6, we have a bought in October 1998 for 397,000, a current GV of 1.18 million, a list price, these houses were all on the market, of 1.35, and a priority amount of 990. It didn't sell. They're actually, of these 8 properties, only 2 of them sold. Number 7, bought in 2014 for 812,000. Mortgage taken out in 2016 with a priority amount of 1.38 million. So 500,000 more than the purchase price just 2 years before. And number 8, they were sensible sods who bought their house for 160,000 in 2003, and they didn't have a mortgage on it. So it was nice to see that there was somebody out there who'd paid it off. I think across the country, what we've got is these priority lending figures are there. I don't think that purchasers of properties are actually aware that these things are there, and that the banks have got complete control over your options for refinancing if circumstances change or if rates change moving forward. So it's just something that I would say to you. Well, when you are taking out a mortgage, be careful. Give yourself a buffer and let them take a little bit of priority lending, but be very, very mindful of how this can be manipulated in a downturn.
And there's a couple of other thoughts that I had, Joe. Firstly was that if in fact the limit that's effectively put on is higher than effectively the current mortgage that's being paid, which is what I think you're saying, because it's got some headroom, right? It's an interesting question then as to whether the bank should hold capital to the limit or just the outstanding balance, firstly. And secondly, if you're a mortgage broker, I wonder whether a mortgage broker, if they're involved, actually get commissions based on the credit limit versus the actual amount drawn down.
Yes, a big question to ask. I don't know.
Well, I can tell you that here in Australia, until quite recently, it tended to be the limits rather than the actual amount of drawdown. And in fact, that's beginning to change now. So the focus now is more on, paying commission based on the true amount being drawn down. But there was a bit of an incentive to actually lift the limit higher, because effectively mortgage brokers potentially could get a bigger commission. And in Australia now, it's not totally clear to me as to whether in fact the capital that's held is against the true balance or whether it's the available balance, right? And that's an area of muddiness in the way that the reporting works. So again, not only do you have issues with regards to the borrower and their ability to borrow more, but also there's a broader implication in terms of the funding and the capital within the structure, within the system. So I think it's an important question.
Yeah, and it's interesting. And I believe that a lot of the valuation of property has been very relaxed when it's come to mortgage lending in the UK. The work that's done when a mortgage offer is written, it's quite extensive, and it got a lot more extensive after 2008. Well, really 2007. Very, very common to see down valuations of property. So if a deal was done, if the comparable evidence didn't stack up, and we're not talking about, oh, well, that one sold for next door, but one for 10% less, you'd need to have 15, 16 transactions to compare it to from the last month or so's data. I don't think that's happened over here. I don't think that the valuing on behalf of the bank lenders has been as stringent, and I don't think there's been any recourse. We're going to see it because we're going to go through exactly what I've seen before. What I would also say is that these priority lending amounts, they very, very easily allow you to get involved in the whole property hype bubble of, okay, well, I've got this priority lending, let's have another 200 grand down, let's go and put it into a buy-to-let property. And what I understand is, and we've not got open banking in New Zealand yet, and I'm not sure where you are in Australia, but there's quite often you'll have an investor with a portfolio where he'll have the family home with one lender, maybe 3 or 4 other lenders. We've actually got members of parliament who are property investors who've got mortgages with several banks when you see their disclosures. But do the banks know, okay, well, a family home has been remortgaged for $1 million on a position that it's worth $2 million, say, but it's then been remortgaged again for 500,000 with another lender and another 500,000 with a third lender. All 3 of them have a claim on the title, and perceivably at that value. But do they each know? Not at the moment, where their other exposures are. So it's going to be interesting.
Well, in Australia, we're just getting into positive credit reporting, so we never had it previously. So effectively, a lender would be myopic in terms of the particular transaction, not really understanding the full financial footprint of the borrower, unless they were very transparent and open. And of course, that was fine in a rising market because the bank always believed that prices would rise. Therefore, there was always plenty of equity in the transaction, so they weren't too worried. Whereas now, because prices are sliding and because the whole basis on which lending is made is tighter, they're really asking questions. But my data shows how remarkably high numbers of property investors have basically taken that deposit from their main residence and then thrown it across to an investment loan with another lender.
Yeah.
And so at the moment in Australia, it's pretty clear to me that we've got this deck chair stack, right? And if the first drops over, all the others fall over too, because this isn't necessarily just one property, but in some cases, property investors have got 2, 3, or 4 investment properties leveraged off each other, leveraged off the capital from that first property, and very significantly, quite often interest only.
Yep.
And now we're in the situation where a lot of those interest only loans are up for review, and suddenly people are finding that they're required to make a 40% increase in the monthly repayments because they are no longer eligible for interest only loans. And so that's one of the reasons why in Australia now some property investors are looking to sell quickly to get out before prices slide further. So it shows you that in a rising market, you can get away with some of these behaviours, but when the market begins to turn and when a greater focus is put on lending standards, a lot of these behaviours and practices just dissipate, and that can really pull the rug out from the property market as well as from individual borrowers.
Yeah, it's very interesting. I mean, Edwin, I think, mentioned it in one of your posts a few weeks ago, and this is very much what we saw in the UK. There's been so much leverage put into the upper end of the market. We ran that baby boomers time bomb post a few weeks back. And what you found is that, okay, their price has gone up, but they've leveraged and leveraged and leveraged. And they've used it to really boost the lower end of the market. Now, in a property correction, what you tend to find is that the top end slides and the percentage terms are normally far greater. People will talk about, oh, well, you'll see 10% off the market this year. Actually, the realities are it's normally 15, 16, 17% at the top end, 10% in the middle, and 4 or 5% at the bottom. Now, in the UK, what we had was a market where the very upper end of the market, the volume of transactions just dropped off a cliff, and it's never really recovered. And it's because so many of those sellers, they're just sort of stuck. They can service things while they've got their investment portfolios, but actually there are no buyers for them because the only people that could buy them they're actually stuck having over leveraged themselves at the bottom end of the market, competing with the very investors that have gone and bought the stock at the lower end. So yeah, my view is that we'll see this over the next 12 months. The housing supply that we talked about in Auckland, just the amount of building going on around the country, there is going to be pressure, and these investor pockets. Barfoot and Thompson, their annual figures last year, they were talking about an 11.8% increase in the number of sales of units that were less than 500,000 on their 2017 sales. That's quite interesting because their lower end proportion was 11% higher than it had been the previous year. So they're already seeing reduced volumes at the top end and more volume at the lower end. So yeah, interesting times ahead, Martin. And priority lending, I think, has given people just a blank checkbook to go back and get what they wanted on an easy lending environment.
It's all what it's all about, but I suspect the environment is changing. Joe, I appreciate your time today. Thank you very much for that.
Thanks very much, Martin.
Thanks.